The truth is that we needed a reckoning. We needed a recession anyway.
Well, it's certainly going to smack a lot of people in the face as far as debt is concerned.
Our strategy there is to buy the dip. The price of oil was absolutely cut in half.
My fortune is a consequence of being aggressive during bear markets.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
What's up, guys? Jay Martin, CEO of Cambridge House here, and I have a few more conversations that I want to share with you today. Now, because of my conference business, I always have friends and buddies calling me asking, what is your network saying? What is your network doing in this market? And there's no simple answer to that question. But it made me think about some advice I got when I was 18 years old and I was working on this ranch up in northern British Columbia for this crazy old cowboy. And he used to always tell me, Jay, the secret to success is having the ability to spot an avalanche and put yourself in front of it. Now that's simple advice. And it's what we're all trying to do in the market, right? We want to Wayne Gretzky this thing and get to where the puck is going to be next. Now, nobody really knows the answer to that question. The best thing we can do is gather as many perspectives and opinions as possible and then apply those that make sense in our life. And that's why I share these conversations. We can look for hints. Like right now, every asset class in the world is being sold in a flight to US dollars. There's more wealth consolidated in USD than ever before. And eventually that wealth will be redistributed to other asset classes. And that's the avalanche we want to get in front of. So what I've done is I've identified individuals that meet two criteria. Number one is they've been serially successful for the last decade or three, predicting market trends and allocating cash. And number two, they are right now sitting on a surplus of US dollars that they plan on redistributing. We're going to find out where that money's going. I connected with Rick Rule, CEO of Sprott US Global, because Rick has been dedicated to the precious metals industry for his entire adult life and very, very successful. Now, he's successful for a whole number of reasons. His work ethic is second to none. He has this insane ability to spot up-and-comers before anybody else does. But what Rick credits as the number one factor contributing to his success is bear markets, moments like right now. I also connected with famous US investor Jim Rogers, who founded the Quantum Fund in 1971 with George Soros, and after only 6 years delivered a 4,200% return for his shareholders and then retired at the age of 37. But what he really did was purchase a motorcycle and travel all over the world, investing in hated on countries and beaten down asset classes, making hundreds of millions of dollars in the process. Today, Jim has his eye on places like North Korea, Venezuela, and Zimbabwe. He's the author of several best-selling books, and I wanted to find out what Jim is doing today. I also caught up with Dave Cole, CEO of EMX Royalty Corp. Now, Dave's a veteran in this business, having spent over 18 years at Newmont Mining Corporation prior to founding EMX. And the reason he's on this video is because EMX is currently sitting on over $50 million US. They're in hunting mode looking for new deals in the market. And I wanted to find out where that money's going. Okay, guys, we're going to jump in. I hope you enjoy this. And if you did, please click subscribe. And then in the comments, let me know who you want to hear from next, and I'll go get them. Okay, well, you know what? When I was doing some research for this conversation, I found a clip of you in 2013 at our show in Vancouver. And you had some advice for investors then that was every investor, every person in this market should do two things. You should own bullion and you should keep cash.
I think that investors have to do two things, both painful. One is that investors have to own bullion. They have to own bullion. They have to own something that's a medium of exchange without being somebody else's liability. And they have to own a currency, bullion, that doesn't have a political constituency that's in favor of devaluation. The second thing that you have to do, which might be harder for some people, is you have to have cash.
And anybody who followed that advice is probably super happy they did. So I'm curious, do you still think that's prudent advice that people should undertake today?
I think it's more prudent today than it was then. The circumstance that we find ourselves in today is widely credited, if that's the right phrase, to the virus. But the truth is that the impact of the virus on the world and on our own everyday life is partly a function of the fact that we became too confident and in Taleb's words, fragile. Cash and bullion make you anti-fragile. The way that you make this a better world is for everybody themselves to be more anti-fragile. And so, without being too philosophical, gold is in many senses the ultimate liquidity. It's a medium of exchange that's simultaneously a store of value. It isn't a promise to pay, it represents payment itself. The other form of liquidity, which is to say fiat, specie, US dollars, Canadian dollars, whichever currency you principally transact your life in, gives you both the courage and the means to take advantage of volatility rather than being taken advantage of by volatility. So I would suggest to you that the recommendation I gave in your 2013 conference is timely forever, but particularly timely today. The beauty of talking about it today is that the efficacy of the advice is so evident.
No kidding. Now, US dollars and gold are really the only two asset classes that haven't gotten smashed in this crisis. Are you long or short US dollars right now?
I'm very long US dollars. Now, I need to say, and I'm not an economist, I am, as you know, a credit analyst and a speculator. But I would suggest to you that the strength of the US dollar isn't so much reflective of the strength of the US economy as it is the weakness of competing fiat currencies. Doug Casey describes the US dollar as the prettiest mare at the slaughterhouse. That might be a bit of extravagant condemnation. But the truth is that despite the fact that your US dollar denominated savings will go down in purchasing power over time, you still need to have it. You still need to have liquidity, because that liquidity will give you the tools and the courage, as I say, to take advantage of other circumstances. Yes, your dollar will purchase you less next year than it has this year, but you have to have it because it's an insurance policy. And in tumultuous times like these, being uninsured is financial suicide. Gold, by contrast, is tailor-made for a circumstance like this. The gold price moves when people lose faith in the purchasing power of savings instruments denominated in fiat currencies, in particular when they lose faith in the US dollar. And the whole set of circumstances surrounding the US dollar in the longer term, I think, is negative, despite the fact that I think that you have to own it.
Mm-hmm. Yeah, so you see that point where people do start to lose confidence in the US dollar. And there's so much selling pressure everywhere right now in this flight to USD. Is there the potential for a bubble in US dollars?
I think we're in a bubble in US dollars. I think that we're in a bubble in fiat currencies. Let's think about the value proposition offered up by the US 10-year Treasury, which is the global proxy for investment and savings instruments denominated in US dollars. Jim Grant famously describes the US 10-year Treasury as evidencing, quote, return-free risk. Think about the concept of return-free risk. The idea that trillions of dollars is parked in return-free risk is the definition of a bubble. Let's examine the phrase return-free risk, and that'll give you a sense of the bubble. Quantitative easing is really counterfeiting. It's debasing the currency, and yet it's wildly popular. In other words, it's guaranteeing that the purchasing power of this odd instrument called the US dollar goes down over time because they're printing more and more of them, despite a shrinking economy. Secondly, the quality of the credit, the quality of the institution issuing the US 10-year Treasury, which is the US government. $22 trillion in recourse liabilities, likely to go up by $3 trillion at least this year, with $120 trillion in off-balance sheet liabilities, which is to say that the credit quality of the issuer of the US 10-year Treasury is getting worse and worse, even as the instrument becomes more and more popular. And finally, the reward offered to take the credit risk, 0.6% in a currency that the Congressional Budget Office describes as depreciating in value by 1.6% a year. The fact that people are willing to park their money in an instrument that the government guarantees you will lose value in tells you that you are in a bubble in the US dollar, a bubble that's likely to continue.
No, actually, in that same interview, you identified two items that you said were the biggest problems in America. The first being the citizens' reliance on the government, and the second being quantitative easing or counterfeiting, as you call it. And as we walk through this crash, that reliance on government help has just dramatically increased, both in Canada and in the US. And, things like payroll subsidies, forgivable government loans. As a business owner, this all sounds great, but makes me super nervous about what this is going to cost me later in my career. What do you think we're setting up for here, like 5-10 years down the road?
I have two comments to that. The first is that you would do well to link from this interview to your live conference, wonderful conference that you did not too many months ago in Vancouver, and link to the interview that you did with Conrad Black, who described so eloquently the penalty of the citizenry relying on the government.
In addition to being self-defeating economically for the whole country and terribly unjust for an important section and region of the country, it's just bad economics, and it's self-impoverishing, and we shouldn't be doing it.
The second is to say that we are, at some point in time, going to run out of blank checks. What we see in many senses with regards to this reliance on government is really a forward shifting of benefit to my generation and a backward shifting of cost to your generation. The number that we talked about earlier in this career, the $100 trillion in on-balance sheet obligations faced by the US government. And by the way, this number doesn't come from an old anarchist crank named Rick Rule. It comes from the Congressional Budget Office. The truth is that the face of those unfunded liabilities is staring at you in the screen. It's people like me at 67 years old who have promised ourselves Medicare, Medicaid, Social Security, all that kind of stuff. We've decided to consume the benefits now, and we've decided to leave the bill for you. Thank you. I appreciate it. But your generation needs to consider that legacy.
Mm-hmm. And part of me hopes that this event is going to be a very loud wake-up call to my generation specifically. I was born in the mid-'80s in Vancouver, Canada. By all metrics, modern, clean, safe, easy to find a job, very, very comfortable. With that comfort comes, no fear of debt, all this. And, you've been through a number of crashes, right? And in my life, the crashes that we've gone through, people come out typically the same on the other side, right? They go back to their same spending and borrowing habits, et cetera. Do you have any reason to believe that this time it's different, that the cut is deeper and this may change our behaviors?
I do. I believe that the best cure is the disease. And in fact, I believe that this circumstance will be a circumstance that won't be cured in the near term by government. And I believe the consequence of the reckoning that people will go through will cause them to re-examine their relationship with society and government, and I hope cause them to decide to be more anti-fragile themselves. The way that you help society through this crisis is by helping yourself through this crisis. There's nothing selfish about this. The crisis that faces 7.7 billion people on Earth is at once a global crisis and 7.7 billion individual crises. My belief is that your generation has the best access to information that has ever existed. And the fact that you're doing this interview with me today suggests that your generation values user-generated content, not content which is digested and supplied to you from on high. And the very sense that you have a better education than the generations that came before you, and you have more access to information and access to more voices, tells me that yours is the most teachable generation that we have ever seen. It isn't to say that every member of your generation will take the lessons and apply it to their benefit and hence to society's benefit. But the truth is that the salvation for each of you lies to the left of your right ear and to the right of your left ear. The sooner that you recognize it, the better off that your generation and society as a whole will be.
Yeah, that's super optimistic. I love it. And I appreciate that, Rick. Thank you. Now, I mean, let's get into the crash a little bit, because the near term looks quite terrifying. And I've heard you say numerous times in regards to the resource market, bear markets are the authors of bull markets.
Always, each and every time, a bear market is the author, is the cause of a bull market.
Does this statement work conversely? I mean, we're coming off the heels of an 11-year hyper profitable broad market rally.
It does, depending on your time frame. It's interesting that at 67, with less time left on Earth, I've become more patient as a consequence of my experience. I think that we're in a gold bull market now, a metal market. I think that every aspect of the economic circumstance that we find ourselves in, except for the specter of default, is bullish for gold. In my experience, gold moves before the gold stocks do. The impact of higher gold prices has to be reflected on the income statement and then the balance sheet of the gold mining industry before the gold stocks move up. And over the last 45 years, there's been as much as a 6 or 7 month lag between a move in the gold price and a real move in the gold equities. And I would expect in this case past its prologue. With regards to the rest of the commodities complex, as you suggest, in addition to dealing with the economic slowdown that's a consequence of the world shutting down with the virus, we have to unwind the excesses of an 11-year-long recovery. The truth is that we needed a reckoning. We needed a recession anyway. My fear as an investor, and in fact as a 67-year-old investor, is that we were going to face a long, slow, grinding bear market in the economy and a long, slow, grinding bear market in industrial materials, which are economically sensitive. The COVID virus, for whatever bad things it did, hastened that demise. The oil price decline from $60 US to $20 US is ample evidence of the damage done by the unwinding of the excesses of the last 11 years. So what I would suspect is that the sell-off in commodities will be sharp rather than slow, which will actually hasten the recovery. I'm not suggesting that we'll see a recovery in the broad commodities markets this year or even next year. But what I am suggesting is that the decline that we're seeing in commodities markets and the lack of availability of capital in a capital-intensive industry will reset the balance between supply and demand earlier than I would have anticipated, albeit in an extraordinarily messy fashion. And Jay, when you rebalance supply and demand by reducing supply to meet demand, you set the stage for a rip your face off rally 2 years or 3 years from now. Because when the supply-demand balance tightens and prices begin to move up, the industry can't increase supplies quickly to meet that demand because the resource business is so capital-intensive, so cyclical, and because the lead times are so astonishingly long. You can't adjust supply back up. You can't crank open a gate valve and have more oil come out of a well that's been shut in. That's not the way it works. Don't look for a recovery necessarily this year. Don't look for a recovery necessarily next year. But out of this circumstance, well, let's say it differently, and I've said it to your conferences many times, the cure for low prices over time is low prices. Your listeners, particularly the young listeners that haven't been through this before, with regards to their investments in commodities, have to ask themselves a key question. Do they think in 6 or 7 years from now that the material life that they enjoy will be more or less the same? Do they believe, as an example, that they will enjoy breakfast, lunch, and dinner? If they believe that the answer is yes, they'll be able to eat, that means that the price of things like fertilizer, natural gas, potash, phosphate will have to increase, because otherwise there won't be any fertilizer, which means they won't have any food. Similarly, do they believe when they leave their bedroom and go down to the garage and they turn the key to the right, unless they're Tesla drivers, will the car start? If the answer to that is yes, then they believe that oil prices will return to the cost of production, which is about $50 a barrel. If not, there'll be no oil, there'll be no gasoline, and their car won't start. Do they believe when they walk into their room, or God willing, your conference in 5 or 6 years, and they flip the light switch, will the lights go on? Will there be electricity? If the answer to that is yes, then that means that the price of things like uranium to generate the electricity, or copper to distribute the electricity, will rise in price to the cost of their replacements. Now, understand that these comments are long-term comments, 4-year comments, 5-year comments. The bull market that's in front of us right now is precious metals. But when the commodities come back, mark my words, nobody will be anticipating that commodities are the place to be. And they will really, truly be the place to be. I'm going to make an offer on this video later on to your listeners and viewers, where I share 2 charts with them. One, a 45-year chart for the Barron's Gold Mining Stock Index, which will tell you where these companies are in terms of valuation compared to the last 45 years. Hint, they're cheap. And a commodities chart that will talk about the value of commodities relative to other financial asset classes over the last 100 years. Hint, they're cheap. But those charts will put where we are and what to do in great context.
Okay, I love it. And, you know, it makes me think of some comments you made on the stage in January. I saw you at the podium in our speaker hall, and you were telling the audience that if they were in the room during this presentation, they had no excuse not to make a killing.
In the market that we're in, never mind the market that's coming, you have absolutely no excuse not to make a lot of money.
In terms of precious metals, I was curious, a lot's happened since January, if you're still as bullish in the near term, and it sounds like you are.
A little more. The truth is that we're talking from a lower base.
Sure.
And I was thinking that there might be a circumstance that would cause people to lose faith in the US dollar. Well, that circumstance is with us now. The black swan, or the gray rhino, depending on the metaphor that you propose to use, is in front of us. Now, I need to tell you that when I say in the immediate future, it might take a year. After 67 years, 45 years active in investment markets, as I say, oddly, I've become much more patient. In the gold mining index chart, which I referred to and which I will send to any of your listeners that want to see it, there are some wonderful visuals which go very much to the question that you've asked. The first is that in terms of the periodicity of oversold bottoms in the gold equities markets, the one that we are in the midst of now is unusually long of tooth, which means the duration of this bottom in the historical context has been very, very long, which suggests that in terms of this bottom, we are approaching the bottom, at the bottom, or just off the bottom. The second thing that we see from this chart, which is very germane, is that there have been 8 recoveries over 45 years from oversold bottoms. The least upside offered in these 8 prior recoveries was 150%. The best was 1,200%. And this was from the indexed, not from the best of the best stocks. In other words, the index as a whole recovered by 180% on the low side and 1,200% on the high side. And these recoveries have taken place in periods of time as short as 12 or 13 months, or as long as 42 months. So in terms of making money, you don't actually have to own the index. You don't have to own the best stocks. You just have to participate in the beta. You just have to participate in the market. But the truth is that that beta occurs as a consequence of multiple alphas. And People who, first of all, don't make egregious mistakes will do better than the market as a whole, because the market as a whole is comprised of the great unwashed, whose main investment technology will be got a hunch, bet a bunch.
Right.
The
Okay.
real money, the extraordinary money, will be made by the audience that comes to your conference and applies the lessons that they learned there. That's very important. It really, really, really gets down to stock selection. In interviews like this, particularly to younger people, I make fun of speculation because younger people are too narrative driven and too speculative. But the truth is, Jay, and your father can tell you this, he's known me for 40 years, all of the money that I now invest prudently, I made by speculating. But I didn't speculate wildly. I paid attention to who the best people were. I paid attention to geology. I paid attention to balance sheets. I paid attention to income statements. Those people who do what I asked them to do at your conference, those people who apply themselves, buy the best of the best, particularly if they can do it, buying them in private placements, will do even better than a market whose 8 prior recoveries have varied between 180% and 1,200%. And that's a recipe for fortune indeed.
Now, you've made a career out of picking alphas, Rick. Are you deploying capital right now, or are you waiting a little bit for things to get a bit worse?
I'm employing capital right now, although I expect things to get worse. One of the things I've learned in my life is the correctness of the Buffett phrase, that one prospers by being brave when others are afraid and afraid when others are brave. I'm not necessarily going in at market. I've enjoyed the last 20 or 30 days by stink bidding things, by putting in prices below market at prices that I would be ecstatic if they filled. The truth is that the panic that's in the market and the volatility that we see in the market means that I have gotten fills in the last 20 days that I would not have dreamed of in my wildest dreams at your conference in January. So yes, I'm deploying. Yes, I'm making myself deploy during periods of time when I'm afraid, because I'm less afraid than my competitors are.
Got it. Now, can I ask, are you looking there for further up the food chain? Are you looking at majors and producers that maybe you wouldn't normally buy, but now are too attractive to pass up?
2 answers to that. For my own portfolio, I have a lot of bullion. And for my own portfolio, I am already full up the best of the best. I don't need a larger allocation in the best of the best. Most investors are not like me. Most investors are only talking about gold as opposed to buying gold. For most investors, the way that you take advantage of a gold bull market is you buy some gold because you don't have any. The second thing that you do is that you buy the best of the best, because the best of the best are de-risked and they move first. The fortunes will be made by people who buy the best of the best, have their confidence restored because they move first, and then move further down the feeding chain where information is less equitably distributed. Jay, if you had me and 50 other people from the gold stock community describing and discussing Franco-Nevada or Barrick, the truth is that I wouldn't necessarily be the most knowledgeable person on the call, because information concerning the best of the best is freely available and ubiquitous. But there are some names in the sub-billion market cap space where if you had me on the same call, I would absolutely excel. And the way you outperform the market is by working harder than your competitors and understanding information that is not ubiquitously distributed. That requires work, of course.
Yeah, and you know, reminds me of another Buffett quote I've heard you say: if you want a winning basketball team, you need some 7-footers, right? And then that lower tier deals where the information is less equitable, I mean, you're looking, it's all about the people, right? You're betting the jockey, you're following the personalities.
It's wonderful that you bring that up. It's wonderful that you bring that up. There's so many quotes. Luck favors the trained observer. The harder I work, the luckier I get. what you find is that performance among the junior miners is concentrated among a very, very, very small group of people. And the first thing that you do before you worry too much about anything else is that you study the track records of the management teams and the promoters and look for people who have been serially successful. One of the things that you may or may not recall you and I describing in January when we spent some time together was my rather rueful observation that had I worked less hard over the last 40 years and just hung out with Robert Friedland and Lucas Lundin and Pierre Lassonde, Bob Quatermain and Ross Beatty. In other words, had I confined my efforts to the 10 or 12 most talented people I knew and not paid attention to anything else, I would have worked 25% as hard and made 3 times as much money. And so other than making fun of myself, I think the value of that observation is precisely to go to what you said. You got to find some 7-footers and you got to hang on to them really tightly.
Okay, now I have a question for you because you've probably seen more deals in this sector than anybody. And I was curious if when you're in the boardroom and a CEO is pitching you, have you noticed any common red flags that as soon as you hear or see, you know you're out right away?
The best one was taught to me by Doug Casey. When somebody comes and pitches me a deal, I want to know how much of their money is in it and at what price. I prefer to do business with partners, not employees. And Doug Casey taught me that despite the best will in the world, if someone isn't going to get really rich from their current endeavor, or at least don't believe that they're going to get really rich, they're not going to work hard enough to make me rich. So I look for alignment. Now, if somebody has 10 million shares of a deal that he or she cut themselves at 1/10 of a penny, and they're proposing to let me in the deal at 50 cents, that's not the same as alignment. That's a trap. I'd like to see people that have as much as 5 times their annual compensation invested in the company. And it doesn't need to be old folks like me who are already fat and rich. There are people in your generation who have already exhibited competence that are very large investors in their own deal.
Got it. Okay. Now, Rick, you've given us a ton in the last 30 minutes, and I want to wrap it up asking you for one more actionable takeaway. If somebody's watching this video and they have not been in the market, they've been watching, they've been learning, and what's the number one tool they could add to their tool belt today to maximize their upside and limit their risk?
Work. The number of individual speculations in a portfolio should correspond roughly to the number of hours per month that a speculator is willing to spend studying his or her portfolio. Go for online information, but read the filing statements, read the annual reports, read the annual information forms, read all that kind of stuff. Do the work. That's important. But if I may, I'd like to offer up some assistance to your listeners and readers.
Please.
Any of them who would like my guidance, any of them are encouraged to email me personally. The email address is rankings@sprottglobal.com. Include in the body of the email, not as an attachment, the names and symbols of the publicly traded natural resource companies that you own, or the funds in the sector that you own, and I will personally rank those 1 through 10, 1 being best, 10 being worst. And I'll return those to you. I'll also comment on individual issues where I think my comments might have some value. Please don't include names like Royal Bank of Canada or Canada Tire, or things where my opinion isn't relevant. I really want to employ the lessons that I've learned over the last 45 years to help people get through times that are probably without equal in my lifetime, And of course, I'd like to indirectly familiarize people with the value inherent in the Sprott organization and Cambridge.
Rick, that's super appreciated. Thanks so much.
Always a pleasure. I look forward to continuing these video discussions, and I look forward to catching sight of you live when this foolishness is past at one of your wonderful conferences.
Likewise. All right, that was Rick Rule, CEO of Sprott US Global. Now we're going to switch to the founder and CEO of EMX Royalty Corp, Dave Cole, and find out what he's doing with his $50 million. Enjoy. All right, so right now, Dave, we're going through this unprecedented crash, and I wanted to ask you, because you spent 18 years at Newmont, then you founded EMX, or what became EMX, in 2003. You've ridden through a handful of market crashes.
Yeah.
So I want to compare this one from your perspective to the most recent 2008. What strikes you as the same or different?
You know, we have ridden through a few rather attenuated market cycles since we've had EMX Royalty Corporation and the predecessor companies. And that definitely breeds some gray hair, is what I'm going to say. But you know, there's some interesting similarities actually between the global financial crisis and what we're going on here. You saw the price of gold moving up in expectation of there being some financial strife. And then actually during the phase of liquidity crisis, you saw the price of gold sell off precipitously. And that was the case in the global financial crisis, and it was the case most recently in the last couple of weeks. We saw some days there where the price of gold sold off dramatically. And I heard a lot of people saying, oh, gold is dead. You know, it should be going up. I said, no, this is actually behaving the way you expect it to, because when people have a liquidity crisis, they've got to sell whatever they've got to sell to be able to meet the demands that they have in front of them. And then, as is the case with the global financial crisis, because of increase of money supply and QE, et cetera, then people say, hey, you know, I'd like to have some currency diversification. We should own some gold. And you start to see precious metals marching up. And that's been the case this last week. It's been a little more telescoped. The time frames have been a little bit more compacted this time than in the global financial crisis. But the trading patterns have been similar in my view. And all this talking about market cycles reminds me of a saying that Rick Rule says, right? He says, don't be used by the market cycles, but use the market cycles to your advantage.
Mm-hmm. Yeah. Awesome. Yeah. I mean, Rick credits the biggest factor in his success has been leveraging bear markets.
Yeah.
That's what he says. So do you have any expectation for this? I mean, yeah, crazy selling pressure. Every asset class is being sold off, and mainly to jump into US dollars. Do you think this selling pressure is going to continue through the summer, or do you think we're getting closer to the end?
You're speaking, Jay, about the broader market or about the natural resource market?
The broader market.
Yeah, broader market. So there's interesting push and pull going on. So there is a devaluation of companies because of lack of income or lesser income going forward, which would be driving valuations down. At the same time as the government is dropping huge quantities of money and increasing money supply around the world, but the U.S. government is probably leading the path with respect to that policy, and so all that money has to go somewhere, and so people are looking for assets to put those monies into. So that's a push and pull. It's difficult to say, but it does feel as though the continued market volatility will be here for months to come. Bouncing around, we've seen the Dow go up and down 1,000 points a day, for the last few weeks. So,
Now, with this consolidation of wealth in U.S. dollars, if even 1% goes to gold, I think we're in for one heck of a rally. Silver hasn't really responded at all. Now, do you have any thoughts on why that is?
So during my whole career, the silver to gold ratio has deteriorated. And that largely was driven because they're both precious metals, but they both have industrial uses. And so that's an interesting dynamic in the market. One of the huge industrial uses for silver historically was in photographic film processing and developing film, developing prints, et cetera. There's still some silver used in that, of course, but not nearly to the degree that it was back when everybody used to shoot rolls of film and send them off to Kodak to be developed. So with the decrease in the industrial demand for silver for that capacity, I believe that's one of the large factors that has changed the silver to gold ratio. So you've gone from a silver to gold ratio years ago in the 20 or 30 range, even less at some point in time back in the 1800s, to now one over 100. We just recently cracked over 100. I believe we touched 120. It's 111 today. And that's an interesting phenomenon for sure. But I was just doing a little research on this the other day. In fact, Jay, there's about 12 ounces of silver for every ounce of gold on the planet. So in terms of rarity, silver is much more rare than the price indicates, which is an interesting phenomenon. A lot of people call silver the poor man's gold. When you do see periods of financial crisis and the general public wants to gain precious metal exposure, silver prices can explode. And I'm long silver. I bought some silver recently. I think it could be in a position where it's poised for a move. But I love diversity. I think owning some platinum is good. Palladium, it looks overpriced to me. In my opinion, palladium's overpriced. But platinum, silver, gold, all good commodities to be exposed to hedge against the devaluation of the currency caused by helicopter money.
Got it. Yeah. Now at EMX, you've got a lot of exposure to gold and a lot of exposure to copper. And at my conference in January in Vancouver, everybody at the podium was a copper bull. And we're talking short term, medium term, long term.
I like copper. Copper is a very good metal to hold for the long term. So I define investment horizons short, medium, and long term. And copper's, I think it's good short and medium and long term.
Of course, this is before the world fell apart, so to speak. Now, how has your forecast been tempered by the last month and a half?
Oh, yeah, I'm happy to describe that. So first of all, let me just talk about copper and gold in general. So copper and gold tend to run in similar geological environments. So with respect to leveraging our geological talents to build an asset base of mineral rights, the two can go hand in hand. But they're also beautifully complement each other with respect to portfolio diversification, one being an industrial metal, one being a precious metal. And so we like that diversification within our portfolio. Historically, as per the folks you just mentioned, we also were bullish copper, short-term, long-term, medium-term, you name it, we're bullish copper. The use for copper across our economy is robust, and there's all kinds of new uses being invented with electrical vehicles and on and on and on. But the amount of copper that goes into refrigerators and wiring, et cetera, is increasing every year. So we love both of those commodities. But with respect to, you asked specifically, how have recent events affected my outlook for the metals today? And we are distinctly bearish on copper short term. I'm surprised that the price of copper has not fallen further, as akin to the price of oil, for example. The price of oil was absolutely cut in half, maybe a little more than cut in half. And copper has been surprisingly resilient to that. That's perhaps telling us something, or it's just overdue for a little bit more of a correction. So short term, we're very bearish copper. Long term, we're still exceedingly bullish. And so our strategy there is to buy the dip. I don't think we need to be in a big hurry. We don't need to run out today. This is a space where we're going to utilize the strong treasury that we have to look at the market landscape, look for folks that need capital to advance some of the best copper deposits in the world, or some of the most prospective terrains for copper in the world, and find out how to get that exposure to our shareholders so we can take advantage of that shift as we look out years ahead.
Yeah, so right. So this opens up potential hunting season for you then.
It sure does. Yeah. EMX is in an enviable position in that we have over $50 million US in the bank and no debt. And so we're in a situation where we can sit back and analyze the landscape. And copper is one of the things that we're looking to buy on the dip.
Got it. Okay. Now, I just want to touch on the pandemic real quick because it's dominating our headlines, obviously, and you've probably got a unique perspective with projects literally all over the globe. So how concerned are you personally, Dave, about the coronavirus and the pandemic?
Personally, for me and my family, so we took precautions early, and we're living a good life, taking lots of minerals and vitamins and getting lots of sleep. Sleep is very important for your immune system. I've been watching the MedCram updates. I recommend everybody watch those. There's excellent information in there.
Okay.
So, certainly we're all at risk, and we should be careful when we're going out. With respect to our most important natural resource we have at the company, our employees, everyone's healthy, touch wood. We commonly work remotely because we work all over the planet. So we're on, video calls. We were doing this before it was in vogue, right? And so, the team's pretty high functioning right now. People are working remotely very efficiently, and we're being shown a plethora of opportunities. So we're taking advantage of that. I do want to point out that EMX was one of the few companies that backed out of and did not go to the PDAC in Toronto this year.
That's right. I knew that.
Yeah, we were following very closely what was going on, and we viewed that having 20,000 of your favorite associates all crammed into one convention center from all around the world was probably not a risk we wanted to take. So we elected not to go. Took a little bit of criticism for that at the time, but I think retrospectively, that was definitely the right move for us.
Yeah, absolutely. Okay. Well, thanks for touching on that. Now, I want to get into your shareholder base a little bit, because the list is like all of my mentors and gurus in this industry, from Rick Rule, Adrian Day, Frank Holmes. So what is it about EMX that's attracting capital from these people?
Yeah. So all of us love the prospect generation business model, and it's a fabulous business model when astutely executed, and acquiring more prospective mineral rights around the world and finding ways to leverage that economic geology modeling that we do of those assets into deal flow, where we're selling those assets onto an industry hungry for new discovery opportunities. And that's a model that group of people like Paul Stevens really espounded that. They love that model. And the way we've tweaked that model specifically is to focus on the royalty component of the deal. So we avail 100% project equity to our customers, who are major mining companies and well-funded junior mining companies around the world. And then focus on making sure that there's good work commitments, annual cash payments, and always a royalty attached to that deal. And we found that if we avail 100% project equity and say, oh, hey, all we're taking is a royalty, so it better be a good one, we're able to negotiate a very good royalty. And that's a great way for us to, quite inexpensively over time, accumulate a vast portfolio of royalties, over 100 royalties now around the world. And of course, we also buy royalties to augment that portfolio, and we also make strategic investments, which is a synergistic way to run at that. And the group of shareholders that you talked about are aficionados of that model.
Got it. Okay, now what's been your biggest win in the last year at EMX?
Yeah, so in late 2018, we consummated a strategic investment that we made in far southeastern Russia. The name of the project was Malmish. It was one of the larger ongoing copper gold discoveries in the world. And we had made a substantial equity investment into the private company that was advancing that discovery. We contributed intellectually as well as financially to that, and happily had a liquidity event where that project was sold to Russian Copper Corporation, and those monies were distributed to the shareholders. That put us in a situation where EMX took back out of it almost $69 million US. I believe our total expenditure over a 7-year period was 11, maybe almost 12 million, somewhere 11 to 12 million dollars we put into that, took out $69 million. Put us in a situation where we had more money in the bank than all the money we'd raised in the history of the company, in addition to the plus 100 royalties and mineral property positions that we have around the world. So that was a great event for us, but it also creates a lot of responsibility, because now we have the responsibility to astutely allocate that capital.
Now, are you getting pressure from your shareholder base to distribute that cash and look for acquisitions?
Yes.
You are? Okay.
Yeah. People think we should run to the Walmart royalty store and buy the royalties that are waiting for us on the shelf. And of course, it's not that simple. We've got a team, we call them the Fail Fast team, with geologists, engineers, metallurgists, environmental guys that are helping us look at the plethora of opportunities that we're being shown, rate and rank them, fail them hopefully quickly, so we don't spend too much time on the ones that we don't want. And the few ideas that trickle on up that we're ultimately meet our filters that we're willing to execute on. And we're pleased to do that. We've seen a few deals that we've announced. We're working on more. But I definitely would agree that shareholders are impatient. They want to see the big grand slam win right away.
Of course. Yeah. And I mean, you're cashed up, you're in a good spot. We don't know really what the next year is going to entail for us. Do you expect it to be a very challenging market for the junior mining industry to get financed?
So most years are challenging for junior miners. So it makes sense that it would be. Jay, there's usually funding available for good teams and good projects. And precious metals or gold is specifically in vogue right now. So there probably will be money available for those. But it is a very good time to have a strong treasury and to take a broad look at the world and look for the best places to allocate capital.
And that's probably your top priority right now. Is that what you're focused on for 2020?
It certainly is. We are continuing our organic growth where we do our prospect generation, which generates royalties, what we call royalty generation work. And despite the COVID situation, we've recently sold a few projects, creating more royalties for our portfolio. And we will always continue that organic growth. That's the bread and butter of the company.
Okay, that was Dave Cole, CEO of EMX Royalty Corp. Now I want to cut to the famous US investor, Jim Rogers. Enjoy. Now, I heard a story about you. Actually, I think I heard you tell it on an interview that the first time you bought gold was in 1971, and it was illegal for Americans to buy gold. So you flew to Canada, Canadian, and that's where you purchased your first gold and brought it home. Is that true?
Well, it's a good story. Let's leave it at that. Okay. I don't want to admit to doing something wrong in 1971, but I have owned gold for decades. I've never sold any gold. I've given gold to my kids and friends and things like that. But no, I've never sold any gold. And I stopped buying gold around 2010. But in that summer, I started buying gold and silver again, because the correction had gone on a long, long time. I expected the correction to be bigger than it was, but it wasn't. So I started buying again.
And you've never sold any.
Might even buy some today. Who knows?
Right. And you've never sold any gold.
Never sold a gram. Never had.
So what's the role that gold plays in your portfolio?
Well, first of all, I like to give it to people as gifts. And sometimes, if you're a really good friend, I give you one of those. If it's less, I give you silver. They're great gifts as far as I'm concerned. But as far as my board, well, Jay, forget me. Everybody should have some gold and some silver as an insurance policy, if nothing else. We all have car insurance, life insurance, fire insurance. We hope we never use our fire insurance, but we all have it. And that's the way one should look at gold and silver in the first place. You've got to have some, you've got to have it as an insurance policy for your life, for your country, for everything. Secondly, if you get the timing right, you can make a lot of money. There have been times in world history when the price of gold or silver or both has skyrocketed. So if you can get the timing right, you can make a lot of money.
Yeah, that's excellent. I love hearing that, and it really reinforces my reason to buy gold, Jim. Like I've never purchased a large quantity all at once. I slowly acquired over the last 7-8 years. I hope I will my entire life, and I hope I'll never need it. But hopefully, it's something I can leave to my kids, right, as that legacy gift. Now, Jim, whether or not the U.S. economy is primed for this crash to happen, the pandemic that we're experiencing seems to have been the match that set this fire. Have you ever seen, or can you think of a crisis like this that has enveloped the entire world collectively like this?
Beginning of World War I had this kind of shock, as recently as July of 1914, there were still people having a wonderful time in markets all over Europe. And all of a sudden, August came along and that ended that, and everything collapsed very quickly. It's happened before. I don't know of any time in peacetime that it's happened this quickly. Maybe in 1929, the markets collapsed this quickly, but the economies didn't collapse this quickly. So I guess the answer, other than the summer of 1914, I cannot think of any time. Maybe August of 1939, I'd have to go back and look. But in 1939, it was not the whole world. It was just a few European countries. So I doubt it. I'd have to look, do a little homework. But I as far as markets and economies happening this fast, other than August of 1949, I don't know, of 1914, I don't know of any time.
Do you expect the world is back to business as usual, or will there be some things that are forever changed?
No, it will not be back as usual. Some of the trends that are happening, all trends that are happening will be accelerated. But certainly, Jay, I've already said, America and other countries have added staggering amounts of debt. The world is not going to be the same. The UK used to be the world's dominant power. Then the UK government, for whatever reason, added huge amounts of debt, and they lost their status as the world's reserve currency and as the dominant country in the world. That is already happening with the US. And you look at what's happened. I mean, the US now does not even have enough tests for its country. We had 3 months notice that this was coming. We don't even have tests. We cannot test 325 million Americans. We don't have enough respirators. We're getting respirators and tests from the Chinese. The Chinese have 1,400,000,000 people, and yet somehow or another, they have enough tests and respirators to send to the US. Do you think this makes the US look good to most countries in the world when the Chinese are sending tests and respirators to Italy and to Sudan and other countries around the world, and the US is sitting here begging to get tests? How do you think the world sees this? I know how I see it, and it grieves me. I don't like it at all. I'm an American citizen. My kids are American citizens. Jay, these are things that were inconceivable to the human mind 20 years ago, 200 years ago, 100 years ago. These things never could have happened, and they're happening. We're sitting here watching them. So no, these are things that are going to change many people's perception of what's going on in the world.
Is there a chance this breeds a smarter generation? And I mean, if this economic fallout lasts as long as some people predict, yourself included, I think you said this will be the worst bear market of your life. And, I, by all means, grew up in a very affluent generation. I was born in Vancouver, Canada. I'm 35 years old, not scared of debt as many in my generation are. And you look back at people who grew up during the Great Depression, they never took on $1 of debt in their life. And, this could be a great wake-up call for a large amount of people. Is that the truth?
Well, it's certainly going to smack a lot of people in the face as far as debt is concerned. You're going to see bankruptcies of people who didn't handle debt properly. It's always happened throughout history. People were overextended, got smacked, and went bankrupt, and learned the lesson. But this time the debt is much higher than many periods in history, and there will be more bankruptcies. So a lot of people are going to grow up saying, I'm not going to have debt. They're going to be scared of debt. Rightly or wrong. It doesn't matter if they're right or wrong. That's what's going to happen. And the people who can handle debt properly are going to do okay. That's like a Porsche. If you handle your Porsche properly, it's great. You can go around and pick up boys, pick up girls, whatever you want to pick up. But if you handle your Porsche wrong, you're going to wind up in a graveyard somewhere. So that's the way it is with debt too. Be sure you understand it and you can handle it.
Now, I'm not sure if you've seen this, Jim, but there's been an argument online that's been gaining steam and noise, and it's really centered around the response to the coronavirus, that the human cost of this economic crash drastically outweighs the human cost of the pandemic, and our response is backwards. Do you have any thoughts on that?
Well, it's certainly an argument to be made that the cure is worse than the disease. I already mentioned to you before, that in the U.S., we've added staggering amounts of debt. What about young people? If you're 25 years old in the U.S. or 35 years old, this is going to have a devastating effect. on your life, just as a young Englishman in 1919 or 1926. You know, their lives will change forever because the English made many, many mistakes. It is a legitimate discussion that we should have, because how far do you go?
Now, I want to touch on something that you said earlier. You know, the 20th century saw power shift from the UK to the US. And maybe you hinted that the 21st century might see power shift from the US to Asia.
Well, yeah, not just Asia. I mean, Japan is going to be a disaster 40 years from now. 40 years from now, it may not be. Where are we going to get our sushi in 40 years? I mean, Japan's got serious, serious problems. So when I said a power shift, I didn't say just to Asia, some Asian countries, but it's mainly going to be China, whether we like it or not, Jay. I mean, you know, the 19th century was the century of the UK. The 20th century was the century of the US. The 21st century is going to be the century of China. Doesn't mean there won't be problems in China. There will be huge problems.
All right. Now, Jim, if you were just beginning your investment career today, what country would you start in? Where would you be located? And what would you be looking at?
Well, if I were smart, if I were 26 years old, 22 years old now, I would go to China, learn Mandarin, and learn the investment business, even if I had to start as the receptionist or the messenger. I would learn the investment business, and I would do it in China. Now, that's because I love the investment business. Jay, if you don't love the investment business, forget it. Don't do it. Don't even try. Do what you love. The most important thing I can tell anybody is to do what you love. No matter what other people, especially if other people say it's crazy, you do what you love. That's what's going to make you happy. And the happy people are usually the most successful people.
Now, what has been the most useful tool that you've used to be successful as an investor?
I guess the most important thing, the place to start for me, and I always start in balance sheet. You must understand balance sheets. Now, that's an easy statement to say, you take a course of balance sheets, but unless you really understand the nuances and can see what has been happening to a company's balance sheet, that's where I start. I always start with the balance sheet to find out the real condition of a company. The income, I mean, there are many things you have to look at, the income statements, management, et cetera, but a real understanding of the balance sheet, and I don't mean just that these are assets and these are liabilities, has been useful for me. So I guess when I know when I see some change, when I see something changing, that is the single most important thing. And that gets me to go and look at the balance sheet. That makes me go and look at industries or companies when I see something changing, especially if it's something cheap. You know, when you were born, Vancouver was there. Vancouver was not what it is now. I mean, that's an example of dramatic dynamic change over the past 35 years. I mean, it was a backwater. 35. Whatever they tell you in Vancouver now, I can tell you, 35 years ago, Vancouver was a backwater. Look out the window. It's full of Asians. It's dynamic. It's a major world city, getting more and more exciting every day. You want another one like that now? Go to Vladivostok, on the Russian Pacific port. It's when I first went, I had to sneak in 1990. It was illegal. It's a closed city because that's where the Russian Navy was. Now it's becoming it will become one of the most exciting cities in the world. Medellin in Colombia, Medellin used to be the center of the drug wars. If I were interested in the Spanish language, I'd move to Medellin tomorrow. Education is going to change dramatically. Maybe all those beautiful buildings at Princeton will be, maybe all the 18-year-olds will go there, but they'll go there as places to live and play sports, et cetera, But education is certainly going to change dramatically. As I said, my daughter's downstairs right now. She goes to what is the most difficult school in Singapore to get into. She's downstairs having class on her computer, which it's never happened. Never happened in the history of Singapore, but now it's happening. If I were in charge of education, I would make everybody learn a foreign language, and I would make everybody live a year or two abroad. Best part of education for me, I went to a couple of prestigious universities, but the best part was going far away from home. I've told my daughters, you can go to university anywhere you want to, but you have to go away. You cannot stay home. You have to go far, far away to university, because that's the best part of education.
Okay, that's it for today, guys. I hope you enjoyed this. If you did, please click subscribe and then let me know in the comments who you want to hear from next, and I'll go get them.